What if the market just stopped going up? Not a crash, but also not a quick dip and then a recovery, but a prolonged stretch, years, where the market grinds sideways or slowly works its way lower, and your portfolio just isn't doing what you've been counting on it to do. As investors, we all have recency bias, but this sort of prolonged downturn happens in the markets, and the real question is, when it happens again, will you be ready? I want to talk to you about what this means for your retirement portfolio and exactly what you can do right now to prepare. Got that and more coming up. Let me be super clear right up front. I am not here to predict the next market crash. Nobody can do that consistently, and anyone who says that they can, you should turn and run the other way. Michael Berry, who famously called and bet big time on the housing bubble. I love The Big Short movie. I don't know if it's listed as a comedy / thriller, kind of funny there, but yes, he predicted the housing bubble. And then he's predicted dozens of crashes since then and been wrong on all of them. So I'm not predicting, but I am reminding prolonged market downturns happen. And I want to help you be prepared. Because here's the thing, being prepared for a prolonged downturn costs you very little if the market keeps on booming. You remain on track for your goals in your retirement, but not being prepared, that can cost you everything, moving you off track from your goals. So let's talk about what's actually going on right now, what history could tell us about what we're experiencing, and then 3 things that you can do right now to protect your retirement. First, where are we right now in the market cycle? Are we recovering off of a bottom? Obviously not. Are we in the early or maybe mid stages of a growth period? Or are we in the late stages, maybe nearing a peak for this market cycle? That's really the question. Several metrics have been pointing to us being in that late stages of the growth cycle. One is the Shiller PE ratio or CAPE ratio. That's the cyclically adjusted price to earnings. It compares stock prices today to the average earnings over the last several years adjusted for inflation. It tries to answer a simple question. Are stocks expensive or cheap today relative to history? The current reading for that Shiller PE ratio at the time I'm recording this is around 41, okay? However, the long-term historical average is around 17. So roughly speaking, the market is priced at more than twice its historical average. Now that doesn't mean the market is about to crash. No, it doesn't. But there have only been 2 other times in modern history where valuations have gotten near this level. One was 1929, the other was December of 1999. And you know what happened after both of those. So I'm not trying to scare you, but again, I want to remind you and help you get prepared, because layered on top of those elevated valuations, we've got real uncertainty in the market right now. Geopolitical instability, questions about whether AI hype and all that will actually translate to actual earnings, interest rate uncertainty. These are not reasons to panic, but they are reasons to be thoughtful. And the reason I'm especially focused on this for you is because you're approaching retirement or you're already in it. And for you, a prolonged downturn isn't just an abstract market event or a buying opportunity, which it should be for many people. It's different for you. It feels different, and it could permanently impact your plan. So what can you do about it? Here are 3 moves that I want you to think through working with your CFP and looking at all 6 areas of your financial life. Number 1, build the right retirement income structure. The number 1 mistake I see people make as they're heading into retirement is this. They don't build out a specific structure for their income. They just have a pile of money and they figure they'll just pull from it when they need it. That approach, it works fine in a bull market when, stocks are advancing. It works terribly in a sideways market, and it means your plan will crash in a down market. Here's a better approach. Structure your portfolio into buckets. We call it the personal pension plan. A short-term bucket that's 2 to 3 years of your income needs in something stable. Your money market, your CDs, maybe some short-term treasuries. Not in the stock market. That's the big idea. This is your paycheck for the next few years. Next, an intermediate term bucket, and that's the next 5 to 7 years worth of those needs. Designed for some growth, but also some very intentional defensive positioning. And then lastly, everything else, that's your long-term bucket, invested for growth, because you won't be touching those dollars for 10 plus years, where your short-term volatility is far less dangerous. Why does this intentional structure, this buckets of money, why does it matter if we end up seeing a prolonged downturn? Because if the market drops significantly in year 2 of your retirement, you are not forced to sell stocks at the bottom just to pay your bills. Your short-term bucket is there. You let the long-term bucket ride. You don't panic sell and permanently lock in losses. This is the personal pension plan approach. It's one of the most powerful tools I know for navigating market uncertainty in retirement. Point number 2, you got to get serious about diversification. Here's the thing a lot of people don't realize about the lost decade. Yeah, the S&P 500 went basically nowhere from 2000 to 2009. That's a lost decade. But other parts of the market did just fine. Small cap stocks had a positive return over that decade. International stocks were positive as well. Even bonds or real assets, they were positive also. The investors who got crushed during this time period, they were the ones who were essentially all in US large cap stocks, or maybe just in technology. The investors who did okay, yeah, they were diversified. And that's a great reminder and very relevant today. The S&P 500, I've done some videos on this, is more concentrated than it's been in a very long time. The top 10 companies make up a huge portion of the overall index. Most of those companies, they're in technology or AI adjacent companies. And that means if those companies correct for any reason, the whole market's going to feel it. Diversification isn't about giving up returns. It's about not having all your eggs in one basket that happens to be sitting right on the edge of the table. So the point, look at your investment mix. Are you over-concentrated in large cap stocks? Do you have international exposure, small cap, mid cap? Are your bond holdings appropriate for your timeline and risk tolerance? Should you actually be owning treasury bonds right now instead of bond funds? This is not a one-size-fits-all answer, but it is a conversation, an intentional conversation that you need to have so that your retirement is ready in case we face a prolonged market downturn. And then item number 3, you've got to know your real retirement income number. Those first 2 things that I mentioned, those are market risks. They happen to you. But this third one is completely in your control. I've worked with people who have had plenty of money to retire on paper, but they've never actually sat down and figured out what they genuinely need to spend every single month. Not what they hoped, what they actually needed. And guys, that number matters a lot in a downturn, because here's what happens. If your spending is higher than you actually planned, you're withdrawing more from your portfolio, and that portfolio then isn't growing. You're accelerating the drawdown. And once that momentum builds, it's very hard to reverse. Think back to that personal pension plan you actually spend through. If you overspend what you expected, you spend through that short-term bucket much faster than anticipated, and then you are into that forced selling of investments before they've had a chance to recover. So here's how you do this. Guys, if you are approaching retirement, do a dress rehearsal of that spending right now. Whatever you believe you're going to spend in retirement, try living on it for the next 6 months. Does it work? Does it feel right? Do you find yourself reaching for more? This is not about deprivation. It's not about, the picture's about to, snap. Let me suck in my belly. No. This is about entering retirement with an accurate picture so that when, not if, markets get volatile, you are making decisions from a position of clarity, not scrambling. Because guys, here's the point. In retirement, and throughout your career, but in retirement, markets will go up and markets are going to go down as well. Sometimes they're going to frustrate you for years. Sadly, those market moves, they're out of your control. But a well-built, comprehensive plan, that's well within your control. That brings all 6 areas of your financial life together, and where you're proactively planning through things like a prolonged market pullback, or things like taxes, maybe estate planning, Medicare, Social Security. That proactive planning gives you the structure to stay on course and have confidence in the face of uncertainty. So work with your certified financial planner on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with a K, wisefinancial.com. You can find us here as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.